Hello, everyone, and welcome to the journey to multifamily millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us Stephen Wasylkiw. Stephen is the CEO and founder of Magna Vita Investments, a nationally recognized real estate investment firm specializing in the acquisition, development, and management of multifamily and commercial properties. He has been investing in real estate for more than a decade, and his investment philosophy has been to get high returns with conservative projections. Stephen, welcome to the show.
Yeah, thanks, Tim. Thanks for having me. I love this show and I'm glad to be here.
Yeah, and it's great to have you on. So, I gave everyone a high level overview of your background, but on this show, we really like to get down to the details of how you got started on your journey to multifamily millions. So, please tell us a little bit more about yourself and what brought you into the multifamily space.
Yeah, so a little bit about me and my company. So my name's Stephen Wasylkiw. I'm 36. I'm a multifamily syndicator here in San Diego. My company is called Magna Vita Investments, which means great life in Latin. And we provide people with an alternative to stock market investing. So it's offering people a chance to get returns around 12 to 8% through passive real estate investing. So we own some property in San Diego, in Chicago, and in our portfolio right now, we've got some short-term rentals, some medium-term rentals, and also obviously some long-term rentals. And right now, we're specifically focused on apartment deals in San Diego around the $10 million range or less. And I wanted to come onto this show to really share a couple items that are I feel are underutilized in this space and that I don't hear talked about a lot. Resources that I've personally used and that most people can use to push their deals across the finish line.
Yeah, and I just wanted to hit on a couple of things that you mentioned right there. So I love that name translating to great life because that's obviously, one of the things that you're trying to provide for your investors is a way for them to reach that great life. Part of that wealth building strategy, I assume, is what you're kind of insinuating there.
Yeah, and we want everybody that's affiliated with the organization to kind of live out that great life mantra, whether it's the investors or the employees or the communities that we're providing value to.
Awesome. And so you talked about the different types of investments that you're currently in. And some of the things that you said were short, medium, and long term rental. I think most of us know what short term rentals are and long term just being like a regular lease. What
Mhm.
exactly falls into the category of like a medium term rental?
Yeah, so a medium term rental would be anything from 30 days to a year. And a lot of the medium term rentals now or have come forth because of short term rental laws in certain cities, or HOAs are pushing back on short term rentals. So in our case, most of those started out as short term rentals, but because of municipal codes or laws changing, we've had to change them to medium term rentals where we're finding traveling nurses to fill these furnished medium term rentals, professionals. I've had zoologists in there that are coming to the San Diego Zoo to work. I've had engineers coming here to work for SCG&E, just all kinds of traveling professionals end up needing a place to stay and they like that medium term furnished option.
Yeah, that's great because you're filling what is a clear gap in the market,
Exactly.
and something that's not really addressed by the long term, regular apartment buildings, we'll just say, because they don't like to have anything less. I mean, they don't like to have anything less than 12 months, but,
Yeah.
certainly not less than 6 months. So it sounds like you're catering to that group. One of the other pieces that you hit on was providing an alternative to stock investing. And I think this is a point where a lot of people, and I talk about this all the time on the show, is that people don't really even know that there are alternatives. So do you find
Mhm.
yourself having to educate a lot of people on the fact that this opportunity, these assets even exist as a way to invest their money outside of the stock market?
Oh, 100%, especially in certain niches in San Diego specifically. So there's a lot of biotech companies here in San Diego. You have a lot of high income earners a lot of very intelligent people, but they're very underserved in the deals that they see. They're not very involved in business or finance. So they're not really aware of some of these real estate investment deals that they can be a part of. And instead, they end up, losing 10, 20, 30% in the stock market, like I have too personally. So I have my own little stock portfolio, but I'm heavily invested in real estate.
Right. And I think that's important to know. Like, don't get me wrong. Sometimes I bash the stock market, but it's not to say that I don't take part in it. I just think one investment vehicle
Yeah.
is less volatile and more lucrative than the other. But there's certainly a place for diversification here. I think the point that you and I are trying to push is that most people do not have diversification because
Mhm.
having a bunch of different stocks is not diversification.
Yeah. Yeah. And then a lot of people try to diversify into the same silo. So they're going to own six different biotech companies, but that's not really diversifying your portfolio because if that sector takes a hit, you're going to take a big hit as well.
And then, of course, we could go down the rabbit hole of the diversification that's even available within multifamily or, you know, commercial real estate itself. There's plenty of opportunity for diversification even within the asset of commercial real estate. You said you do deals in San Diego. Are you exclusively in California?
Not just California, we have apartment units in Chicago as well. But as of right now, I'm focusing more on San Diego.
And I find that interesting just because so many people that I know aren't willing to play in that sandbox, as it were, because it's not what most of us would consider landlord friendly. So, what challenges have you faced, if any, trying to build your business in California? And how have you been able to kind of evolve around that and be successful?
Yeah, that's a good question. It's something I hear people talk about all the time. We don't want to invest in California, and I get it, but California is massive. Think about how big California is. You're saying you don't want to invest with like a 30 million person population, which in different areas of the country is 20 states. So I think because I've lived here my whole life for the most part, I'm comfortable in the areas that we're investing in. Specifically, San Diego, I've lived here almost 20 years. So I know each individual pocket very well. And when it comes down to landlord laws, those really are county by county because the sheriff's departments are the ones that are actually, doing the eviction notices or handing down any of those judgments. So it's really more of a county by county basis. And in terms of San Diego, it's one of the more conservative parts of the state. So we're pretty comfortable. I have personally not have had any issues in California, but I've had more issues in Chicago than I have in San Diego.
Wow, that's really interesting. But I think that take makes a lot of sense. I talk to other investors who invest primarily in what we would consider very expensive markets, whether that
Yeah.
be like New York City or Boston. And then,
Hmm.
of course, California would probably fall into that too in most locations. But they found a way to make it work because so many investors stay away because
Hmm.
they know the markets so well on even like a block to block basis in
Yes.
some circumstances that they have the competitive advantage and they've been able to leverage that into success in those areas.
Yeah. And then another reason why I love San Diego so much is that it's geographically restricted, right? You have the ocean exactly to the west and you have Mexico to the south. So it's not like, I'm not trying to bash any other markets, but it's not like a Houston where you can just expand and expand, right? Like there's no land here in San Diego. I've seen just insane appreciation that has really boosted into my net worth a ton. So I like having the cash flow in Chicago and in the Midwest, and then I like having the appreciation on the West Coast. And I feel like a lot of people are doing that. They're kind of leveraging their West or East Coast salary, putting it into the Midwest for the cash flow, but then banking on the appreciation on the coast.
That's interesting. Yeah, I hadn't thought about that. Like sometimes we dive deep into the numbers and we're looking at it, so much as a business plan. And some people warn against relying on appreciation but
for
but
sure.
it is a thing, and that's the reason why we focus so heavily on picking a market, right? Like we don't want to pick a tertiary city,
Mm,
wherever, where there's no job growth, no population growth. And part of the reason why is one, we won't have any renters, but two, we won't see any appreciation. Appreciation comes from demand. So
yeah.
you're absolutely right. With that limited supply that you have in that constricted geographic area, you're going to have higher demand, and that's inevitably going to drive appreciation.
Yeah, so you'll use those Midwest properties to get your monthly cash flow, and then the coastal properties, I mean, you're still making a little bit of cash flow. It is expensive. I'm not gonna say that it's not, because it absolutely is. But I mean, we've made, multiple 7 figures just on appreciation, and then you're making really just the month-to-month income on the Midwest properties.
Nice. And so a lot has been made of the, mass exodus from California to come to basically my backyard,
Mm,
places like Tampa, Florida,
yep,
or Arizona, for sure, in
yep.
some of those Midwestern hotspots. What do you make of that? And is that something that you've seen and has impacted your business?
For me personally in San Diego, no. I think the net migration here is around flat, which is fine. We have a massive healthcare space here, biotech, like I said before, and also the military. It's all, I don't see San Diego as anything less than a top 5 market in the US. So I'm not worried about here at all. I do like Arizona a ton, actually. I would not be opposed to going into Arizona, but I'm personally not worried about our investments in California at this time. If it was in different parts of the state, I might be, but for our portfolio, I'm not.
Yeah, and I think that's the important point here is that real estate is local. They say all real
Yeah,
estate is local. It's
yeah,
true. And so to paint, with such a broad brush as to say the entire state of California, people are exiting, it's
mm,
just way too much of a generalization to
yeah,
possibly be true.
yes,
So it's, we have to do our due diligence and kind of drill down again on those markets and see what markets are performing and which ones aren't. Because, yeah, some places are having an outflow for sure. Like that is a thing, but where is that? And we can't just say it's the whole state.
exactly. Yep.
Yeah. So, no, that's some really great stuff. And one thing, whenever I have guests on here who have had, a prior before becoming a multifamily syndicator, corporate job perhaps, what I like to ask them is how have they been able to leverage that corporate experience into what they're doing now, if they have it all? And so
Yeah,
with you, I'd be interested to hear if that was the case.
yeah. So great question. My most recent corporate tenure was at a Fortune 200 risk management. So that has really translated over well into real estate for me, because I'm a certified risk manager. I'm a chartered property and casualty underwriter. So very analytical, very detail oriented, know how to underwrite deals. And I'm always looking at the risk of everything, whether it's in terms of the actual property, like, possible claims on property site, to actual fiduciary risk as well when we're making any type of underwriting assumptions.
And so I guess does that better prepare you for like finding insurance, for example? Do you know the questions that you need to ask and find ways to get better rates because you know the rules? I won't say just as well as the guy who's making the quote, but I feel like that would give you an advantage as well.
Oh, 100%. Yeah. So I used to like actually underwrite these and stuff too at some point, kind of further back in my career. But 100%, I know all the, limits, deductibles, the exclusions on the policy, what triggers what. So yeah, that gives me a huge leg up.
And I don't think, some listeners may realize what an impact that the insurance can have on the
Mhm.
profitability of one of these assets. Can you talk about maybe, I don't know, general percentage that it makes up or how much that can impact how profitable one of these deals is, depending on how high or low the insurance comes out to?
Sure. And it depends where you are in the country too, right? Like earthquake coverage here is insanely expensive. So you need to know if you're in an earthquake zone, if you're in a flood zone, maybe where you're at, you might need to know, do I need to get hurricane or flood insurance? And then that's going to impact the NOI because that's increasing your expenses. So it can play a massive role. And if you don't know how to shop the policies, if you don't know what you're looking for, it can hurt the bottom line and your, return to your investors.
Yeah. And then there's other things that I wasn't even aware of. So, like if you're doing heavy construction on your site, you need a
Mhm.
completely separate policy for that while that construction is going on. We had an asset where, we started off basically at zero occupancy and we're doing full renovations across the board. And then, you know, leasing out the buildings as they completed.
Mm,
Now, what we found is that we were spending a lot on insurance because we had the general
mm,
policy, but then we had I forget exactly what it's called, something construction policy, where that needs to be in place for all the risks associated with construction, personnel, equipment being at this site. So we were very relieved once construction was 100% complete because then we're like, okay, we're done. Let's take it off. And it's saving like, like hundreds of thousands in the long run.
yeah,
Are you familiar with that?
which is huge. Yeah. And then a lot of people aren't aware that sometimes there's vacancy clauses within the policy as well. So if they're doing a really large value add and maybe, half or more than half of the property is vacant, a company can actually deny claims. They're saying this property was vacant and we didn't know. So that can be a big issue as well.
Yeah. No, I appreciate that. And, whenever we're trying to get these deals over the line, capital raising is one of the biggest challenges that we face, getting enough money.
Yeah.
I think traditionally, most of us are either going through like uh, private equity, like family offices, or we're going through what we call limited partners, LPs, which are just regular people who are passive investors in the deal. Do you have any other hot tips, tricks on how to get those deals over the line when you're right there at the edge, but haven't quite raised enough?
Yeah, definitely. So I have a couple tools, and I just kind of want people to think of these as additional tools in their tool belt when it comes to raising capital. So it's not going to eliminate their need to capital raise, but it's going to supplement it so they don't need to raise as much possibly. It's more leverage at your disposal. And that's, leverage is how normal people become wealthy. So first, I want to touch on lines of credit. This is what I've used in the past to get some of my deals over the finish line. And I'm specifically talking about revolving lines. So that's lines that you can pull on at any time and at your discretion. I have certain lines of credit with certain over 200 grand. In total, I have lines of credit over $1 million, which is nice because if we're coming down to a deal and maybe we're short on the raise by 100, 200K, it's right there. I'm not sweating. We're not going to have to cancel the deal. You're not going to lose your EMD. I really think it's invaluable for people to just have this on the sideline. It's like dry powder that you can use if you need to get a deal over the finish line.
Yeah, and just to clarify for the audience, you said EMD there. You're talking about earnest money deposit.
Correct. Correct. Yeah.
Yeah.
And so just diving deeper into some of these lines, I mean, some of the rates can be as low as 3%. I'm seeing up to like 8%. Some of them are fixed rate, some of them are variable, some of them are collateralized, right? Which means that the bank will loan against one of your assets, and some are not collateralized. I have both. I also have personal lines of credit. Most of them are business, but I do, have my own HELOCs that are available if I need to use those. And yeah, they've honestly been invaluable to myself and the deals that we've bought.
Yeah, and you touched on it a bit, but that's what I was going to ask you about is the qualifications for these lines of credit. And you talked about, them being collateralized or not collateralized. Can you talk a little bit more about what requirements these different institutions had to get these
Mhm.
lines of credit?
Yeah, so I've been surprised by a couple of them because some of them have been no collateral, no doc either. So they're not asking you for any type of verified financials. They're literally asking you in an email, what are your sales? What are your projections? And they're giving you like 100K, just no doc, which is awesome for us. I'm hoping it's working out for the banks too. That's been very easy too. And that's the ease of doing business, which is really nice. Usually, though, they do need at least 3 years in business. Obviously, you need to have an entity formed. These are business lines of credit. So you need to have your own EIN. You need to have a DUNS number. There needs to be some type of credit profile that you have, that you've established, whether it's through business credit cards or whatnot. Sometimes they're fixed rates, sometimes they're variable, sometimes that depends if it's collateralized or not. Usually the collateralized loans or the lines, excuse me, will have a lower rate and the non-collateralized lines will have a higher rate.
No, that's all really great information. Hopefully, folks caught all that. Obviously, having EIN, it's basically the social security number for your business. And then the DUNS, I don't know if as many people are familiar with that. I know I had to do a little extra learning. It's like what DUNS and Bradstreet,
Yeah,
yeah.
and Bradstreet,
And
yeah.
and so it's essentially a credit reporting agency for business credit, but it's not nearly as intuitive as regular credit because regular credit just gets reported. It done. The business credit, I feel like you have to jump through a few hoops in order to make sure that it's being applied when you have something like a business credit card,
Mhm.
stuff like that. So it's just not as straightforward. I mean, if you know more about it than I do, could you talk about like how that works in terms of what you need to do and the scoring and how that impacts you and your business?
Yeah, sure. So there's three business bureaus, kind of like personal, and some of them overlap. But the three business bureaus are Experian, Equifax, and Dun and Bradstreet. And then I'm pretty sure any score over 70 or 80 for a business is deemed as good. Maybe it's kind of looked at like a 700 plus for personal credit scores. And as you use these lines, you should be making sure that the bank is reporting these to the business bureaus. It's just going to keep increasing your business credit and give you more opportunities in the future. I'm hoping that kind of answered your question there.
Yeah, and I guess that's part of my question is do you have to tell the banks to report it if you're getting a line of credit like this or is this something that they automatically do? Because you're absolutely right. You want to continue to improve that credit
Mhm.
rating. The best way to do that is to, pay off something like a revolving credit account.
Yeah, I've always checked in to make sure that they are, and they always are. So it's never been an issue for me. And
Yeah,
I've
that
used, yeah, and I'll just give some people like specific examples. So I've used Bank of the West, US Bank, Pentagon Federal Credit Union, Torrey Pines Bank. Those are some of the like specific places that I have my business lines of credit and personal lines of credit. I just like to give people actual examples because then they can go look it up and see if they can get one for themselves. And I have no affiliation with any of these banks at all, but they've been really good to me. Some of them are national, some of them are local. You might be able to even find even better lines in your local areas of the country where there might be, specific little niche credit unions as well.
awesome. No, that is very helpful. So hopefully people keep that in mind that it's not enough to just get that, Dun and Bradstreet number. They kind of need to do a little extra legwork just to make sure that their effort is paying off by
Mhm.
virtue of this stuff being reported up. I did have a question on like you said that you would give them your sales and project. That just seems like it would be a little hard just based on the type of business that we're in and how infrequent, deals go full cycle. How are you
Mhm.
presenting that, I guess?
Yeah, I'm just giving them the current gross rents of all of our properties, and then I'm figuring in kind of the average deal size that we do per year. Like maybe planning on bringing on one or two properties in a year, and I'll tell them that too. I'm like, this is what we're projecting. This is a rough ballpark estimate, and no, you know, way is this guaranteed, but this is what we're thinking because this is what we've done in the past.
Yeah, no, that makes total sense. And it actually brings me to another question on the short-term rental piece.
Mm.
Are those properties, are you syndicating those as well, or are you getting those in a different way?
Yeah, I haven't syndicated those. Those are all personal.
Okay. Yeah,
Yeah.
that makes more sense. And I only ask because I haven't seen many. I think I've seen some short-term rentals where they've been syndicated. And if I have, they've been like large, 8-bedroom cabins in the Smoky Mountains or something where
Uh,
they're ridiculously expensive to rent.
yeah,
I'm
no,
just
but
curious on that.
I mean, don't sleep on the short-term rentals, man. Those things can cash flow a ton. Like some of those will net you in San Diego, six figures net profit in 1 year. So
Yeah, and we could probably do a whole separate show on
yeah,
short-term rentals because there's so many nuances
yeah.
involved. The biggest cautionary note that I tell people is, hey, just know the laws, like you said, because especially when it comes to the short-term rental piece, it can be
Mhm.
down to like the county or city level where
Yep.
it can be completely legal in one city and you go 5 minutes next door to the other city and it's not. So people just need to be very careful before they go in and buy one of these just to
Mhm.
ensure that business plan that they have of, renting it out on a short-term basis is actually legal because a lot of people won't necessarily tell you when they're trying to sell it. That's not their
Mhm.
concern. You're responsible for doing your own due diligence. So that's the trickiest part of short-term rental. But otherwise, you're absolutely right. In the peak season of whatever it is for that property, they could make enough to be profitable for the rest of the year.
Yeah. Yeah, 100%.
Talk to me. Now I'm curious about short-term rentals. Talk to me about your most profitable that you could think of short-term rental and just to give the listeners an idea of what that looks like practically.
Yeah, yeah. So we have a 4-bedroom, 3-bath here in San Diego. It's a house, can fit up to 12 guests. At this point, it's a 7-figure property. It's netting us it's netting us 6 figures in the year. That's after mortgage, insurance, the Airbnb fee, the cleaning fees, the supplies. It's after everything. For one property to net 6 figures in a year, I mean, that's the NOI of some people's buildings, like 20-unit buildings, you know what I'm saying? And to have that under one roof, that's powerful.
Yeah, and I think that goes to like such an important point. Like sometimes we within our respective asset classes get stuck
Yeah.
in that silo,
Mm.
can't see beyond it. Whereas it might make a lot more sense to have a plan of action that involves multiple asset classes so that we're able
Mhm.
to take advantage of the characteristics of each one. So in the case that you're talking about, what I'm thinking is the short-term rentals provide cash flow. Like
Yeah.
and they can provide a lot of cash flow. If you're an entrepreneur, the one thing that you lack is predictable cash flow. It's not like having a W-2 job where on the first to the
Mhm.
15th, you're going to get that paycheck.
Yeah.
And so if you're only doing syndications, it's very sporadic. Can be small amounts other than when you exit these properties. So one way to supplement that might be to have these short-term rentals where you have this more consistent income. So I think that's a really important point that people like me and probably a lot of others need to think about.
Yeah, and that's kinda how it came about too, because I was having a hard time finding apartment deals here that were really penciling out and making sense, and that I was comfortable bringing on investors. So I was like, let me do a little pivot here, try out the short-term rental game. It's only been 2 or 3 years for me, and it's paid off huge. So I feel like you shouldn't over diversify, but keep your options open and maybe limit what you're doing to 1, 2, or 3 things.
Yeah, definitely. All right. Well, this has been some amazing conversations, some like tips that people could definitely implement as soon as they get done listening. But we do need to move into the turbo round. All right. So I'm going to ask you three questions in quick succession that I ask all my guests, and I ask you for your honest answer. The first one: what is one red flag every investor should look out for?
So I would say, I don't know if I'd call it a red flag, but I would say not knowing who the next buyer is. So if you're buying a property and you're going to do a value add, are you leaving some on the bone for the next guy? If you're doing the full value add, is there an institutional buyer there that's willing to take on a 4% cash on cash? You really need to know how you can exit something, or there are multiple exit strategies that you have. I feel like a lot of people go into the underwriting, like, okay, look how well this does, but it's just a projection at the end of the day. They really don't know who might be buying them.
Yeah, that's such an important point, because you're right. You don't want to take this generic approach to the formula, right? Oh, value add. I'll fix up some of the units and raise rents and get more money for it. You have to have that end buyer in mind to say, all right, 30% of the units are already renovated. I'm going to renovate another 30% of those units, add enough value to get the returns that we need, but still make it attractive enough for another value add investor to say, hey, there's still, 40% left to renovate on there. Now
Exactly.
and then you could get even more, I guess, specific about the types of buyers that you want. Like you talked about institutional investors. There's things that they are looking for that you need to kind of plan out for that property in advance. If your plan is to take it up class level, right? It's a B plus in an A neighborhood, and you're able to take it up to that A level and put in the finishes and everything else that's expected, then you might be able to, the institutional buyers, especially if you have very high occupancy, so that they're very risk averse in nature, right? So if you're presenting this beautiful, high earning, low maintenance kind of property, that's exactly what they'll be looking for. And so it makes it an easier sell for investors too, to say, hey, we're already thinking about who we want to buy this property, who being in the general sense, and our business plan supports exactly that end buyer. So that's absolutely right.
Yeah, that's a perfect example.
All right. So the next question: what is a myth about this business that you would like to set straight?
I would say that when it comes to real estate investing just as a whole, that people think they need a ton of money to get started, but there's actually a couple different ways that you can, get into the game with no money. You can do subject to deals, you can do lease options, you can wholesale, you can do rental arbitrage. And that's just a couple off of my head. So I would say if you're really young, don't be too intimidated by real estate investing. There is a way for you to get your foot in the door with essentially no money.
Yeah, exactly. It's just a matter of applying the appropriate level of creativity.
Yeah. Yeah.
And the only way you're going to get that is by being exposed to as much stuff as you can and getting, tips by listening to stuff like this, where you're like, oh, I hadn't even thought about that. No, that's exactly right. And trust me, I've had enough 20-somethings on my podcast to know that even they could do it. And it just makes me wish I had started sooner.
Yeah, same.
All right. So last question: what does success look like to you?
When I hear the word success, I just think financial freedom, not being reliant on, a company or a person for your financial well-being. Being able to spend time with your friends, family, do whatever makes you feel happy, pursue your passions and purpose, pretty much.
Absolutely. That freedom of time, freedom of money. Yeah, we hear that so much on the show. So true. All right, Stephen. Hey, this has been amazing. Please tell our guests how they can get a hold of you, and if you have anything else that you would like to share with them.
Yeah, so they can find me on LinkedIn at Magna Vita Investments or any other social site at Realizing Your Potential.
All right. We will definitely have that in the show notes. Stephen, I appreciate you coming on, and I look forward to continuing to see you do big things on your journey to multifamily millions.
Awesome. Thanks, buddy.